we're going to give up the extra 20 basis points. And I said, there are times when you have to worry about the return on your capital, and there are times when you have to worry about the return of your capital. And this is a time to worry about the return of your capital. And we took our cash out and put it in treasuries. That would have been unimaginable a few months earlier. Similarly, the commercial paper market in the United States came to a halt. So what started out as a disruption in some arcane element, because of the linkages, because of the extent to which people had gotten over their skis, as they say, impacted the nerve center of the financial system. The minute you put the banks under pressure, banks only have three choices: increase capital, reduce what they're doing, or sell their balance sheets. The banks are like the oil in your car. You never worry about them. However, if something happens to the oil in your car, it doesn't matter how good your engine is, it doesn't matter how good your brakes are, your car will not move. And if your car happens to be in a street and it breaks in the middle of the street, you will create danger for everybody else around you. And as you can see, the stock market quickly recognized that the problem was at the heart of the financial system, and it started repricing, as you see from the bottom chart, the whole financial sector in the industrial world. So what was before a liquidity accelerator in the world, creating this wonderful concept of endogenous liquidity, if you had it, you could sell it, turned into a massive downward spiral. And the downward spiral you see up there, it's a very simple one. No matter where you start with a weakened balance sheet. You have to reduce your leverage, which means you have to reduce the size of your balance sheets, which means you're selling assets in weak markets, which further impacts the value of your existing assets, and you get into this massive downward acceleration where the endogenous liquidity contracts. When the tide comes in of liquidity, everything goes up. When the tide of liquidity goes out, everything comes down. Take the banks out, and suddenly the transmission mechanisms that we are so used to break down. And various segments of the markets start breaking down. And the dominoes start to fall. Domino after domino start to fall in the financial system. And that is what we have been living through the last few months. And every week, it's seemingly a new segment. Last week, the Port Authority of New York and New Jersey, the authority that runs the airports, that runs the tunnels into New York, one that normally never had any problem borrowing, saw its auction rate, saw its short-term financing reset at 20%. Because suddenly there was no balance sheet available to provide short-term funding through these auction rates on there. Another domino falling that people never imagined would fall. The problem is that ultimately all these dominoes end up on what they call in the States Main Street. They may start in Wall Street, but they end up in Main Street. And the average US consumer now faces headwinds on account of three very distinct elements. The first one is the credit effect. There is less credit available as the banking system contracts its balance sheet. The second is the income effect. As spending declines, unemployment is going up, and therefore it is more challenging to maintain income, And the third and most important is the wealth effect. For a very long time, the US consumer used his or her house as an ATM. They would go, they would take the equity out and spend it. And as long as house prices were going up, there was a sustainable process. Now, house prices are coming down, and they're coming down very sharply. So again, the dominoes are all falling down, and they're all falling on Main Street. That is the dynamics that we're dealing with. And those dynamics have a natural process of repricing market after market after market, of reducing economic growth, and of reducing wealth in the United States. How about the rest of the world? Think again, dominoes. The first domino to fall is the US. The next domino to fall is the United Kingdom. The one after that would be the Eurozone. And then ironically, because again, it would have been unimaginable for me to say this a few years ago, the last domino, if it falls, will be the emerging economies. It is a complete change in what we're used to. In the old days, when the United States would sneeze, Latin America and Asia would end up in intensive care. Today, the United States is in intensive care, and Latin America and Asia is doing just fine, thank you. Why is that? It is because there is a difference between market relationships and economic relationships. Financial markets are very well integrated. So the minute the industrial country markets have a hiccup, the minute risk appetite goes up in the world, people sell across the board, and therefore emerging markets assets get contaminated. However, we are seeing an economic decoupling, which is very different. We're seeing an ability of the emerging world to sustain economic growth because the endogenous sources, the internal sources are much stronger, and their balance sheets are very strong. Most of these countries shifted from a debtor regime into a creditor regime a few years ago and have massive economic and financial robustness. Imagine again if I had stood a year ago and told you not only will emerging markets be able to sustain their development even though the United States is slowing down, but emerging markets would be a stabilizing force in the global economy. A week ago, I was on a panel at the Council on Foreign Relations on sovereign wealth funds. And I started with a very simple question. What would the Western world's financial system look like if the sovereign wealth funds hadn't invested $69 billion to recapitalize the financial system of the West? Just imagine what it would have looked like. This recapitalization makes total sense because of what I'm going to say in a minute in terms of how the system heals itself. But the current turmoil would have been much greater had the money not come from the developing world to recapitalize the financial firms in the industrial world. The second element is the policy reaction function. It took time for the policymakers to understand what was going on. Now they understand. And you have a massive policy reaction. The Federal Reserve has been very aggressively cutting interest rates, including a surprise cut between meetings in January. You've had a reduction of from 5.25% to 3%. The US Congress has amazingly quickly agreed on a $170 billion fiscal package that will include checks being sent out to consumers telling them, please spend. And of course, the ECB and the Federal Reserve have been reliquefying the system as quickly as they can. So you've had a massive policy reaction. It was delayed because people didn't understand initially what's going on. But there's no doubt as to the willingness of the policymakers to act. The question will be effectiveness. And what we're realizing is that the old instruments we have were better suited for the world of yesterday than they are suited for the world of today. So the policy response, while it is engaged, will take longer to be effective than normally. The third impact is that the world doesn't lack capital. There's a lot of capital in the world. There's lots of people that are very smart investors that realize that there are opportunities today that are opportunities of a lifetime. You see many distressed funds being set up, many bank capital funds being set up, bank loan funds being set up, understanding that these are good assets being sold at very low prices. The trouble is that this capital takes time to be committed. If you want to think of what's going on now, remember what won the Nobel Prize a few years ago, which was a very simple theory developed in 1981. It was called the market for lemons. Anybody who's been in the United States will know that a lemon is the word they use to describe a second-hand car that has problems. If you have a lemon, it means your car is breaking down every single day. The Nobel Prize winners made a very simple observation back in 1981. They studied the market for second-hand cars, and they found the following. Suppose I have been servicing my car, and my car is excellent. Suppose Suhail is looking to buy a second-hand car, but Suhail is very influenced by all the newspaper articles he reads about how people are reconditioning their cars, how they're playing with the odometer. Suhail will never believe me that I have a car that's better than the average. If I want to trade my car, I have to trade it as a lemon. Suhail cannot get my signal because there's a lot of other signals in the air. That is what's happening right now in terms of bank assets. That is what's happening right now in terms of bank loans, because there's so much noise in the system, because there's so much pressure on balance sheets. These assets are trading like lemons, even though they are not lemons. So what does it mean? It means that we are going to see a tremendous change going forward in the way people address their day-to-day business. You already see it on Wall Street. Risk managers have become very important. They now sit in all the meetings. People have recognized that their willingness to exploit financial innovation went far ahead of their ability to understand what they were doing. So there is a let's stop, let's reassess, let's have financial and risk management upfront. Regulators have recognized that all these sophisticated activities migrated away from the banks to off-balance sheets that weren't regulated and that weren't supervised. So there's a massive catch-up process going on in terms of bank regulation. And the investor is starting to realize that AAA doesn't mean AAA, that AA doesn't mean AA, that an investor cannot rely on rating